market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, energy markets appear unconvinced by President Trump's announcement that the U.S. will ensure and escort tankers passing through the vital Strait of Hormuz. Joining us now is John Bilton, Global Multi-Asset Strategy Head for JPMorgan Asset Management, and Paul Wallace, Bloomberg's Managing Editor for the Middle East. So thank you both for joining us. John, I mean, the concern actually with oil is that despite the U.S. assurances to keep that strait open, it just seems very unlikely. And so a lot of oil tankers are going down the longer route.
Yeah, well, I think, when we think about the disruption in the market, it's reasonable to price the very near term. But actually, if we look at the backwardation in the curve, the market's behaving surprisingly rationally. We had the front contract in Brent up around 15% or so since this all started. But if you go back to the December 26 contract for this year, it's only up about 2 or 3%. So as a result, what it's telling you, I think, is that, yes, there are concerns, and rightly so. But remember, we've got decent-sized strategic reserves. China have over 1 billion barrels. U.S. strategic petroleum reserves around 420 million barrels. And across Europe, of course, we have the directive which requires 90 days of imports or 61 days of onshore usage to be held as a minimum reserve. So, yeah, reserves are down a bit, but it's not the world at the moment where I think we've got this sudden and immediate pass-through to, oh, my goodness, inflation, oh, my goodness, the ECB must hike. I think that's taking things a little too far.
Yeah, I mean, I guess the concern, Paul, is that, it's the intensity of the attacks. It's the fact that Iran is really pounding some of the Gulf countries as well. How do you see this developing? I don't know whether there's even diplomatically an off-ramp, right, on the Israeli and U.S. side.
Yeah, and that is the big question. I think it's pretty clear that the intensity and the extensiveness of the Iranian retaliation has taken certainly some people in Washington by surprise. I mean, they didn't have any planning, for example, before they began this attack for escorting oil tankers through Hormuz, for the simple fact they didn't think it would be needed. And now they're having to rush to put these plans into place, as well as evacuating American civilians from Gulf countries and so on and so forth. So is there a diplomatic off-ramp? The short answer is not yet. The Iranians are coming out and saying they will not negotiate. Yeah. They are trying to make out that they are able and willing to continue with their counter-strikes for the time being, whether that's several days or even weeks, we don't know. But they are showing that they have, plenty of ability to continue striking the UAE, Saudi Arabia, and, probably tankers and container ships. And that's what they want to do. I
mean, Paul, again, we don't really have a good handle on the arsenal, right, that's available for the Iranians right now. And so even if you escort, I mean, if you have a tanker escorted by, warships on the side, you have some missiles that you can't really protect them, can you?
It's extremely difficult. I mean, the fact is the Iranians don't need a navy to target ships going through Hormuz. They can use sea drones. They can use short-range missiles, which they have in an abundance. I think the best thing to look at is the southern Red Sea, the Bab al-Mandab Strait, and the Houthis. The Houthis have way less sophisticated weaponry than the Iranians do, and the Houthis effectively closed the southern Red Sea for 2 years. In fact, in some ways, it's still closed. That was just by raising the threat to such a level that Western ships, in the case of Bab al-Mandab, would simply not go through there. They couldn't get insurance. The risks were too high. And even military vessels had problems. Remember, the U.S. did actually face big problems when it was bombing the Houthis. They lost, I think it was two F-18 jets, not in the sky, but when one of their ships had to take a sudden maneuver to avoid Houthi torpedoes or a water drone or something. So it's extremely dangerous, even if you have a military escort.
But, John, I mean, you seem to suggest, I mean, given all of this, you hear Paul talk, and you kind of say this is not going to end well, or certainly this is going to be protracted. So do you think the markets are overreacting?
Well, I don't think they are. I think the markets are reacting rationally. They're repricing things such as oil. They're repricing particularly areas where you've got some level of perhaps needing delay on rates. So we saw what was perhaps unsurprising was the front end of the US curves beginning to price out some of those rate cuts. you're beginning to, you've got in the VIX curve, you've got a gradual decline now out to about couple of months out from now, which suggests some level of continuation of what's going on right now, but eventually the need on all sides to find some sort of negotiated solution. Sure, we're right in the hot point of this conflict, and I think we all hope it's over quickly, but the idea that it's suddenly going to sort of disappear, I think that might be wide of the mark. But equally, I don't think markets should be panicking, because if we look at what's happened, look at the best performers year to date. It's been Europe, it's been Japan, it's been emerging markets. Past few days, all of those markets in equity terms down 5-6%, but there's still, with the exception of Europe, which is now flat, reasonably well up on the year for other reasons. The continuation of demand for chips, etc., which means that even something like KOSPI, which got hit so hard, as you mentioned earlier, it still doubled last year, and it's still up about 20% this year, because the underlying economic stories are still intact. This certainly creates a degree of volatility, a degree of uncertainty, but markets are doing what they should do, which is rationally pricing the risk. When that breaks down, if that breaks down, that would be more concerning. But this seems to be a sensible market reaction thus far.
Now, strikes on Iran, of course, continue, with Israel appearing to have attacked Iran's Assembly of Experts, the clerical body tasked with choosing also the next supreme leader. Now, Tehran has hit back, including a reported drone attack on a CIA station in Saudi Arabia. Let's get straight to Jumana Bersachi in Dubai. Jumana, so how, this is also a critical part of what we're living through. How are the Gulf states responding on day 5 of the war?
Well, we were just looking at the tally of how many incoming missiles and drones the Gulf states have received since the inception of this war. It's something like 1,800, of which almost 1,000 have been directed to the UAE alone. Just to give you the context here of how much of this, how much of the UAE has been a recipient of many of these missiles and drones. Of course, most of them have been intercepted, but some of the debris from the broken drones and missiles have actually managed to sustain damage. And what we've been talking about over the last couple of days is the fact that Iran has started to target key infrastructure hubs, energy infrastructure, logistics hubs. There's still, the airports are still not fully operational. And so the economic costs are beginning to mount here. Now, the language that has come through from many of the Gulf states, they are reiterating their right to self-defense. Yesterday, the UAE had a special press conference repeating that message, but then also reminding Iran that they do have the right to respond as well. And you're hearing that being echoed across many different Gulf states. And so they're in a position now where clearly they want to bring down the temperature and look for a de-escalatory stance. But at the same time, they're still under attack and being forced to go into defensive mode. And the risk here, obviously, is that things escalate even further. And the Gulf states are drawn into a war that they have been trying for almost, the better part of the last year to avoid getting involved in.
Jumana, how much progress has there been on the evacuation of people stranded in the Middle East?
So, very important point, Francine. Since the beginning of this war, it's estimated that about 12,000 flights have been canceled. The major airports are not still fully operational. Over here in Dubai, there are lots of stories and anecdotes, and we have an article up on this on the terminal talking about people who've chosen to travel by car. So many travelers are choosing to choose the route via Oman or to Riyadh, where the airports is still open. And actually, this morning, I believe, the first chartered flight to take out British nationals who've been waiting in Oman is set to take off. There are about 130,000 British people who've registered their interest in going back home. But also this morning, the UAE have announced that they've opened up special safe air corridors that will allow for as many as 48 flights an hour, and another 80 additional flights are also scheduled with a capacity of about 27,000 passengers. So we're beginning to see a slow easing up, but for the most part, the big airlines in the region, Qatar Airways, for example, extending their suspension of travel until Friday. Emirates today, but will likely be extended to tomorrow, similar to what we're hearing from Etihad Airways. So we're not fully up and running yet, but some contingency plans have been kicked into action.
Jemana, thanks so much. Jemana Bersetchi there in Dubai. Now, we're back, of course, with John and Paul. Paul, I mean, if you're a Gulf state right now, you'd want this to be over. And again, we're talking about the off-ramp. But, are we expecting Iran to be much more aggressive in targeting energy infrastructure? Because, they have only to lose if this continues. And so can they convince the U.S. to back down?
It is. I mean, as far as the Arab Gulf states are concerned, yes, they want this over straight away. They wanted it over, they want this over yesterday. This is, it's not a cliche or an exaggeration to say this is a nightmare scenario. If you are Dubai, if you're Abu Dhabi, if you're Riyadh, if you're Doha. In terms of Iran, yes, of course, it looks completely irrational for them to carry on and take these huge losses. But I think it's important to remember that Iran is not, let's call it a normal country. It's certainly not looking at, the balance sheet and losses and gains in the same way that the U.S. would.
Right.
Its paying threshold is much higher, and it's very much logical from its point of view because survival is now the goal. It's an attack's come, and the U.S. has all but said this is about regime change, and Israel has said this is about regime change explicitly. So for them, survival is what they want. So for them, it makes perfect sense to up the carnage in and around the Persian Gulf as much as possible, get oil prices as high as possible, LNG prices as high as possible, stop container ships going through Hormuz, because that raises the pain and the hurt that the U.S. is feeling, and that may force the U.S. to try and find an off-ramp. Of course, Trump will be loath to take that off-ramp without declaring victory, but it certainly makes it harder for him because things aren't looking great from Trump's point of view right now. Yeah,
especially with Congress maybe starting to breathe down their neck. John, what does this mean for bonds and dollar?
So I think first and foremost we do have this general expectation that dollar probably does weaken. A lot of the issues that have gone on in the US in terms of tariffs, etc., point to a weaker dollar, and there's a willingness on behalf of the administration to see it come down. However, it's doing what the dollar does at times of stress. It is behaving as a safe haven. So, of course, for the period that this is a hot conflict, we would expect the dollar to have a little bit more support. We think euro dollar's moved into a range. It's more sort of 116 or so up to the low 120s, and our long-term projection continues to be around 126. The thing we know about currencies is they never go there in a straight line. And, this is something where, we are seeing that little bit of hedging going on in portfolios, which is going to lean a little bit dollar. Some of it's taking positioning down as well. Bonds are a more interesting one because, there's a general undertone of growth around the globe. I mean, for all we're talking about some pretty awful events going on right now, at the end of the day, the growth picture around the globe, particularly because of fiscal spending, capex going up significantly, generally was okay. I mean, this is going to dent confidence to some degree, but it doesn't remove that underlying growth momentum. That probably points to steeper curves over the intermediate term. The risk near term, though, is that folks misunderstand and think that that's been driven by persistent inflationary threats. Yep. Our general view is that oil demand we had expected to come down naturally anyway. Yep. It's beginning to decline, certainly as we see electrification picking up, running into the sort of early 2030s. And, if anything, the rise in prices will take that decline down, which should take a little bit of steam out of inflationary risks.
John, very quickly, when do we start worrying about inflation? So how long does this conflict last until you actually start thinking when you're going to change your inflation expectations?
Well, I think, first and foremost, generally it hits CPI, not CPI core. 10% move in oil generally equates to around a 30 basis point on headline CPI, maybe 5 to 10 on core CPI. We actually think that that's going to take 6 to 9 months to potentially come through. So this is a significant lag when we think about the inflationary pass-through.
I mean, could you see a world, Paul, where a lot more countries actually try and make sure that the Strait of Hormuz is safe? So involving countries like Europe?
One or another, yes. I think it's very difficult to imagine a situation in which world powers are going to be happy with Hormuz being effectively shut for weeks, let alone months on end. Going back to Bab al-Mandab and the southern Red Sea, which effectively closed the Suez Canal for so many shipping companies as well, the world could cope with that. It wasn't so bad going around southern Africa. Yes, it added to shipping costs, but it didn't really do anything as far as CPI was concerned for sort of the US or Europe, whatever. Hormuz is in another league. Just the amount of energy, oil and LNG that goes through there, the amount of container traffic, it's huge. And then all alternatives. There's no, separate route you can take. Yes, the Saudis have a pipeline that goes to their western shores. The UAE has a pipeline that avoids Hormuz by going to Fujairah in the Gulf of Oman. But those pipelines cannot take anything like the amount of oil and energy that tankers going through Hormuz can.
Okay, thank you both for joining us. John Bilton, Global Multi-Asset Strategy Head for JPMorgan Asset Management, and Paul Wallace, Bloomberg's Managing Editor for the Middle East. Now, coming up, conflict in the Middle East rekindles fears of inflation in the UK. We'll bring you more from our exclusive interview with the Chancellor, Rachel Reeves. This is Bloomberg. The UK Chancellor, Rachel Reeves, says the UK won't make decisions about the war with Iran based on US trade ties. Now, she sat down exclusively with Bloomberg after delivering her spring statement.
When it comes to decisions around using British armed forces to take part in conflicts around the world, it is very important that we judge those on whether it is legal and whether it is the right thing to do. You can't make a decision about whether to get British armed forces involved in a conflict because it may or may not make it more likely to get a trade deal. And we judged that there was not a legal basis for offensive action on Iran. But of course, once Iran responded, particularly...
Sorry, not a legal basis for the UK, but presumably not for the US either? If you're making a
we can only make
that.
judgments for ourselves, and that was the judgment that we came to based on our legal advice, and it's up to other countries to explain what action they've taken and on what basis. But once Iran responded in the way that they did, including with missiles being launched into our allies who are not involved in the offensive action, and the risks to our military bases in Cyprus, of course it was right that we became involved in defensive action, and we were involved in that from Saturday, and of course on Sunday we gave permission for US jets to use British assets from which to launch those defensive actions, and that's a decision that we've taken as a government.
Well, that was the UK Chancellor Rachel Reeves speaking exclusively with our Stephanie Flanders. Now, the OBR warns that the conflict in the Middle East could have a very significant impact on the UK economy. Joining us now is Jill Rutter, a senior fellow at the Institute for Government. Jill, as always, thank you so much for joining us. I mean, I have a million questions on this because actually the Chancellor, we knew, wanted this as a non-event, and this is what she got. But does it actually serve a purpose, or does the UK need a bit more radical thinking on growth?
So this wasn't really about growth. This was if you like, a legal obligation that the Office for Budget Responsibility has to publish 2 forecasts every fiscal year. So the Chancellor couldn't avoid having this, but she was determined to downplay it. And I think, actually, given the backdrop against this, the forecast looks out of date the moment they published it, because the inflation assumptions look potentially very optimistic, things about the sort of fuel price and things like that. But against such an uncertain backdrop, this wasn't a terribly valuable forecast to have. So I think it was quite important that she didn't use it to make big fiscal decisions, because I think she would risk looking like Rishi Sunak looked, if you remember that budget back in March 2020, when he made his big budget statement and then a week later had to come back and take much bigger measures to deal with the COVID pandemic. Obviously not on that scale, but I think big decisions would have risked looking very out of date very quickly.
What does the inflation path forward look like, given all of the uncertainties in the Middle East with oil?
Well, what was really interesting about the statement, I thought, was that the Chancellor chose, in her sort of 20 minutes, very short outing in Parliament, to make much of the fact that the OBR was showing a lower path for inflation, and also to claim a lot of political credit for inflation being lower under Labour compared to the big spike under the Conservatives, that spike that was induced by the Russian full-scale invasion of Ukraine. And that looked a bit politically unwise, given now the big uncertainty that your previous guests were talking about when will this feed through, what difference will that make to consumer prices? Will the government be forced to act on energy prices as Rishi Sunak did as Chancellor and then as Prime Minister in 2022, 2023? So I think the Chancellor actually possibly scored a political own goal by laying so much of the blame for the inflation spike that we experienced in the early 2020s at the door of the Conservative government, when really it was world events. She might find herself victim to that as well.
How does it change your thinking on, again, the labour market and what the Bank of England can do?
It's very interesting because, the immediate takeout is, does this mean inflation will be persistently higher in the UK? We've seen those divisions in the Bank of England between the people who aren't convinced that the UK is yet on a safe downward trajectory and those people, the more dovish people who think, there's a lot of slack coming in the labour market, it's time to cut rates. So I think the immediate reaction seemed to be that actually the prospects of rate reductions through the coming year was receding slightly, but we'll have to see. I mean, as everybody says, a lot depends on whether this is a very short, contained blip or whether it really lasts and we feel the hangover effects for the rest of the year.
But, Jill, there's so much going on. I mean, we could be importing deflation from China. There's also a big question mark on AI and whether that helps with productivity, but also just gets inflation down and the, unemployment up. I mean, what are your three big questions that you think we don't really have a handle on yet?
I think we don't yet know. I mean, the OBR itself has said that it needs to look more at some of the effects of the tax system on incentives. So we've got a sort of big thing there of what's that actually doing to work incentives in the UK. I think that's interesting. They single that out. They've also got big question marks about taking into account for the future trajectory the big fall that's coming through now on migration numbers. So there's a big labour market that the Chancellor herself said she's going to return to the question of growth, not in this statement because she was so determined to make it so uninteresting, but in a couple of weeks' time at the May's lecture, and that she may return to some of these issues around the labour market. So I think it's a really interesting question about where is the labour market really going. We saw that the OBR said yesterday that unemployment would spike this year, but spike higher than was expected. So that does look like there's quite a serious softening going on. But the UK is very vulnerable to energy prices. We already have very high industrial energy prices. We have very high domestic energy prices, and that feeds into this big issue for the government that people just don't feel better off. People have had stagnating living standards for so long.
It's also a feeling, isn't it? Is that there's a lot of people that just feel unhappy with this government for real reasons, but also just a general feeling of unease.
Yes, I mean, we have a government that came in with a huge majority on an agenda of change, and I think the feeling year and a half in, we saw that by-election result when Labour came third in a seat that they held, lost to the two insurgent parties, to Green and Reform. So UK politics should be in a period of stability. A government with a strong majority can basically, do what it wants, a Prime Minister with huge authority. That's what you'd expect to see at this time. But actually what we see is a Prime Minister's authority is under attack, where the question is not whether there'll be a challenge, but when there'll be a challenge, and is there only not a challenge because they can't identify an alternative, and that feels unable to push through decisions, lots of changes of staff in Downing Street. So it's a really sort of looks a weak and uncertain government.
Jill, thank you so much. Jill Rutter there, Senior Fellow at the Institute for Government. Coming up next, Continental becomes one of the first big companies to alert investors to the risks from the Iran conflict. We'll be speaking to the tiremaker's chief executive next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says the U.S. will ensure safe passage of oil from the Middle East, but investors don't seem convinced, with Iran's Revolutionary Guard reportedly saying it has complete control of the Hormuz Strait. Conflict in the Middle East rekindles fears of inflation in the UK. We'll bring you more of our exclusive interview with the Chancellor, Rachel Reeves. And Wall Street's biggest private markets firms say investors have reason to be concerned, with the Apollo chief executive warning a, quote, shakeout is coming. Well, Well, Continental shares lower this morning as the tire maker warns its forecast for higher returns may be derailed by the war with Iran. The earnings outlook makes Continental one of the first big companies to alert investors to the risks from the Iran conflict. Well, we're now joined by Kötz, the Continental Chief Executive Officer. Thank you so much, sir, for joining us. Talk to me a little bit about how you're expecting Iran and the oil prices to impact your earnings going forward.
So first of all, good morning and thanks for having me. So, I mean, obviously, we are very early in this situation. For us as a tire maker, but obviously also for our ContiTech business, the Middle East is not necessarily a major market directly for us, but our products are made out of a lot of raw materials which are crude oil based. So one of the potential impacts of the military conflict is obviously on raw material costs. Again, way too early to quantify, but if oil prices continue to rise significantly, we will see impact on our raw material cost side. That's the one potential impact. And the second part is, again, way too early to quantify what the military conflict means for the overall, let me say, economical sentiment. Also very questionable, creates even more uncertainty, which could impact us as any other company.
But Mr. Kötz, again, I think there's always a lagging time between, when you're hit by costs and you can pass them on to customers and consumers. I think it's usually 6 months. Will you have to raise prices in the second half of the year because of what's going on in the Middle East?
Well, first of all, yes, there's a lead time between raw material cost developments and even longer lead time when you talk about feedstocks like crude oil and when those costs will impact our production, our P&L. The crude oil price is obviously only one parameter to determine our raw material cost developments. The other part is the development of the supply and demand balance. And that part is not to be quantified right now, so lots of uncertainty in this area. So, I mean, like in any other crisis or situation we have seen before, we need to handle the challenges. We are confident that we will be able to handle also potential raw material cost impacts coming our way this time, as we have done this in the past.
When will you know, again, how long does the conflict have to last for you to have to pass on these prices? Is it too soon to say, or do you look at previous spikes in the price of oil and oil derivatives, some of the materials that you use to make the tire, and give an educated guess?
Yeah. So, I mean, you asked for the duration of the military conflict. Obviously, the longer the duration, the more it escalates, the more potential impact it has on oil prices as one consequence. And the stronger the impact, obviously, potentially also the stronger the impact on our raw material bill. To talk now about a quantified lead time, so when do we need to make decisions, it's way too early to tell, but it's clear, and that's why we raised this point as well. It is a potential impact for us, again, too early to quantify.
Give me a sense. I mean, you're also, going from, I guess, a 3-division company to a pure auto tire, company, and so you have to spin off some of the other divisions. Does the timeline get complicated because of the war with Iran? Because markets are a lot more volatile than they would have otherwise been.
So we've started the transformation of Continental in the meantime a little bit more than a year or a good year ago. So the first step was the spin-off of our former automotive business, which we have successfully completed last year. And since September of last year, our Movio is now an independent company successfully operating in its own space. The second step was the sale of our OE, so original equipment solution business of ContiTech, which we also successfully closed by the end of January. And now the last step is the intended sale of our ContiTech business, so the industrial piece of the ContiTech business. So we continue to be confident that we will be able to complete also the last step of this transition during the course of this year. And we don't currently see really that the military conflict in the Near East is influencing this plan or impacting this plan.
I mean, if you... Yeah, I understand. I mean, if you look at some of, you have a 2% margin, I understand, and you expect the first half of this year to remain pretty challenging. So where do you see the upside for Conti Tech in the second half of the year?
So, I mean, so we will see, we are pretty confident that we will see for Conti Tech sequential improvements over the year. Why? Number one, we have started a lot of self-help improvement measures, cost-saving measures, restructuring efforts already in the past, so months ago, and we will continue now to see the positive impact onto our P&L during the course of this year with increasing amount. Second, during the course of last year, we have had some one-times, especially in the first quarter, which had let me say, burdened the results in Q4, which will help us a little bit during the course of this year. And third element is, at a certain point in time, yes, we believe that the industrial markets, the underlying industrial markets, will start to rebound and improve again. And we will need this help, obviously, as well to get into this sequential improvement. But we are confident that this is going to take place during the course of this year.
Christian Kötz, how are you expecting margins to develop in the medium to shorter term?
So, I mean, we believe we can improve our margins this year versus last year. So you have seen our results. As a tire business, we have completed last year at 13.6%. Our guidance for next year is now 13 to 14.5%. Why do we use this broad corridor? We use this broad corridor because there's such a huge high level of uncertainty. We just talked about this. And also in the past, like in the Corona crisis, the chip situation, we have used and we have learned that this broader guidance span is helpful to be the reliable partner than being able to deliver then also our results within this corridor. On the Conti Tech side, we intend to improve our margins from last year to 7 to 8.5% during the course of 2026.
Thank you so much for joining us, Christian Kötz, there, the Continental chief executive. Now, the U.S. president, of course, Donald Trump's war with Iran has shaken oil markets and their supply chains. If high prices sustain, the shock threatens to unleash a wave of global inflation. So that's the subject of today's Big Take. And I'm joined now by Ziad Dawood, the chief emerging markets economist at Bloomberg Economics, who co-wrote the piece. Ziad, first of all, thank you so much. And thank you for all of the great work that you and your team have really, put in over the last couple of days. The situation is really changing very rapidly in Iran. How could oil prices be impacted by further developments, first of all?
Would have been massively hit by the war in Iran. Our current estimate is that out of the $84 per barrel, the price of oil now, about $19 is due to the war in Iran. So a significant proportion of the oil price is due to war risk. And I think there are two significant war risks here. One, attacks on energy infrastructure in the region. And we've seen already attacks on Saudi Arabia, on Qatar, and on the UAE. And the second thing is the closure of Strait of Hormuz, which is a very important trade route for crude oil and natural gas. And that's what's caused the lift in oil prices. In terms of what's going ahead, I think there are two factors that will determine how oil prices will evolve in the future. One is the intensity of the war and the attacks, and they've gone as intense as possible, but maybe we'll have more targets. And the second thing is a duration of disruption. We've already had a few days of disruption in the Strait of Hormuz. The question is, can the global economy and the oil market handle longer disruption there? And if it doesn't, we think oil prices can basically go up above $100 per barrel if the current disruptions continue.
So who could stand to win or lose from this oil spike?
Well, in terms of countries, I suppose, if you want to be a winner, I think you need two conditions. One, you need to be an oil producer and exporter. And the second thing, you need to be outside the Middle East. So the countries that fit these criteria are countries like Russia, like Norway, like Canada, that produce and export oil, but they're not impacted by the disruption in the Middle East. the opposite set of conditions will apply to other countries that are set to lose from this. So if you're Europe, if you're China, if you're India, big net oil importers, you'll be hit by the higher oil prices, your growth will be impacted, and your inflation will be higher. And also in terms of sectors, that's in terms of countries. In terms of sectors, I mean, some oil companies that operate outside the Middle East may benefit from higher oil prices, but consumers all over the world will be impacted by this, because higher oil prices does two things. It raises the price for everyone, and consumers are hit by this, and it shifts income from oil consumers to oil exporters, and that creates winners and losers.
Thank you so much, Ziad. As always, Bloomberg Economics Chief Emerging Markets Economist Ziad Dawood, who co-wrote today's big take on the potential inflationary impacts of the Iran war. Read more on the terminal. Now, the Spanish Prime Minister, Pedro Sanchez, speaking from Madrid, says he won't change his position on the Iran war, calling for de-escalation.
We will not be complicit in something that is harmful to the world and that goes against our values and interests simply out of fear of retaliation from anyone.
Well, we're now joined by Bloomberg's chief Europe correspondent, Oliver Krug. Hi, Ali. So Spain's response is highly critical compared to other European nations. Are we seeing a division when it comes to Iran?
Yeah, it's been really interesting to watch this unfurl over the last few days. As you mentioned there, Francine, Spain has really been the most outspoken, the most critical of the United States over the last few days in terms of the European Union member states. We've had some indications also from the UK and from France that basically their view is that the United States may have violated international law. They obviously had some misgivings. I think everybody in Europe has had some misgivings, but they've been, relatively less or more vocal about it. Of course, Pedro Sanchez is in focus now because Donald Trump has now threatened to put a full trade embargo against Spain. This is obviously significant for the Spanish economy. You can see that represented in the IBEX today, which is sold off materially, but it also has massive implications, Francine, for the EU trade deal. The European Parliament was supposed to vote today as to whether or not to continue work on ratifying the trade deal between the EU and the United States. Remember, that work had been frozen after the tariff threats that the United States made around Greenland and also on the Supreme Court ruling, and there's a lot of questions about that trade deal going forward. Now, if the United States is threatening to put tariffs or to put a trade embargo on Spain, what are the Europeans going to do? The Europeans negotiate trade at the EU level, not at the national level, so it throws up about another 1,000 questions for the Europeans, whose trade deal and the fate of that is already in total question, Francine.
So we also have Chancellor Merz's visit to Washington, and that's seemingly been overshadowed by the war in Iran. Has the German Chancellor achieved any of his intended goals?
Yeah, I mean, Francine, if his sort of main goals going into this conversation with Donald Trump, the first of which was to seek clarity on the trade situation, as we've just outlined, it was actually in the press conference with Friedrich Merz, who you basically didn't get to see because all of the questions were directed at Donald Trump, in which Donald Trump announced that basically he put a trade embargo on Spain. And again, after that press conference and after his conversations with Donald Trump, Friedrich Merz basically said there is solidarity with Spain. You can't have basically a bifurcated trade policy within the European Union. So he did not get a great deal more clarity on trade. If not, things are much more sort of opaque as a consequence of that meeting. That being said, we should say that the Germans have been much more supportive of the United States and Israel in terms of their actions in Iran, unlike the French, the UK, and the Spanish, who have been a bit more critical. The Germans have sort of stood behind Donald Trump. But we should also say that the Germans are very sensitive to this idea and to the price of gas sort of elevating. Obviously, it's been a massive story in Germany. The industrial decline over the last few years that has been in large part a consequence of those rising energy prices, which is only getting worse over the last few days. But also for the Germans, key is trying to get Donald Trump's ear on Ukraine. There's a certain Ukraine put on how critical the Europeans can be. And if the two goals were to try to get clarity on trade, clarity on Ukraine, I have to say that the Chancellor of Germany leaves Washington, D.C. potentially a little bit disappointed today.
Ollie, thanks so much. As always, our Bloomberg Chief Europe correspondent, Oliver Crook. Now, there is a headline, an important headline coming in from the MEHR news agency saying that Iran Supreme Leader options have been identified and that Iran is close to selecting a new Supreme Leader. So a very important development that we'll be watching very closely. Now, coming up, a British engineer company, Weir, slumping this morning after it reported earnings. We'll be speaking with John Stanton, the company's chief executive. That's next, and this is Bloomberg. Now, the chief executive of Apollo Global Management says a shakeout is coming for private credit firms as concerns mount over defaults on loans to software companies. Speaking at Bloomberg Invest, Mark Rowan told us the impact will not be short-term, emphasizing the importance of strong risk management.
The entirety of the companies that you see that are public today, everyone was $40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before, because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk.
Apollo Chief Executive Mark Rowan speaking to John Micklethwaite, editor-in-chief at Bloomberg Invest in New York. Now, Weir Group under a little bit of pressure this morning as the British engineering company reported profit broadly in line with estimates. Citi analysts said the lack of guidance beat will have disappointed some, while its organic orders growth was weak. I'm joined by John Stanton, the CEO of Weir Group. John, this market is brutal if you don't exceed expectations. I mean, in general, do you feel like it's just a tough market to please shareholders?
Yeah, well, good morning, Francine. Thanks for having me. Yeah, I think it is a pretty febrile market at the moment. And look, we're really happy with the performance that we've delivered in 2025. Another great year of strong operating profit growth, up 15% year on year. The business is performing incredibly well. We're growing. The demand backdrop is highly active.
Highly active, as in a mess.
Yeah, there's lots of no. There's a lot. The demand is strong. There's a lot going on. There's a very positive outlook for our business. So I think we're seeing the effects of a febrile market this morning.
John, I was going to actually, and I was joking when I said, is it a mess? But in terms of pipeline, so when you see all of the geopolitics, when you see the trade and tariffs uncertainty, the customers want more? Does that actually benefit the pipeline because they say, actually, I want it now because I don't know what happens in longer term? Or does it make customers hesitant?
Well, I think the underlying fundamentals for us in terms of demand for gold, copper and other critical minerals is just really, really strong. I don't think any of the things that are going on in the world at the moment really change that in any significant way, other than the geopolitics of it is going to have an impact on when new capacity gets built. And we do need new supply of all those minerals for a whole bunch of reasons that we all understand. And what's been quite interesting over the last couple of years is just the political response by governments around the world in terms of trying to free up the regulatory frameworks that will enable more investment to happen in mining to deliver those minerals, backed up by the sort of, requirement for now national critical mineral security. It was all about net zero, but now it's about, much broader than that in terms of national security and defence, the whole AI theme. So if anything, it sort of strengthens the fundamentals for us, and it's about now getting on and delivering the investment for the growth.
So which are the commodities you're seeing the most demand for?
So our top three are copper and gold and iron ore. Copper and gold are incredibly strong, a very, very high demand environment at the moment in terms of the equipment and services and software that we supply. Iron ore is remaining pretty resilient as well, and within iron ore there's going to be a big push towards higher and higher grades of iron ore as the steel industry tries to abate CO2, so that's again positive for us. And then some of the things that we help to produce, such as nickel and lithium and the platinum group metals were softer last year, but even they're bouncing back now as well. So we're seeing a recovery in some parts of the complex that were a bit weaker last year.
And John, do you see even at the margins like some of the hesitancy to convert what's in the pipeline to firmer orders, or not so much?
No, I don't think there's any kind of hesitancy among our customers. There's not hesitancy. It's about the practicality of being able to do it. Because it's all about getting the permits and the licenses to be able to build new mines and expand new mines, to have the water and energy to do that. And the political response, as I talk, is really trying to free that up and enable investments to accelerate. So it's difficult to predict when that's going to happen, but we see that coming.
What's your forecast on margins?
We are now, we've achieved our objective of becoming a 20% plus operating margin company over the last few years, so I'm delighted.
Which is not nothing, so congratulations.
No, so I think, it's the hallmark of the quality of the business that we have today. And we're now in a position where we want to sustainably stay a 20% plus operating margin company. And we can continue expanding, but also have the ability to invest in the business, in new technologies, in R&D, in our new software businesses, to provide more to our customers.
So what are the key drivers, I guess, for the next leg of improvement when it comes to margins? I mean, it's, is it software, is it pricing, is it some of the offerings?
For us from here, we've done a lot of structural change in the business over the last few years, which has been about, improving margins, but also about making sure that we've got the right capacity in the right place around the world from a manufacturing and service perspective to deliver on the growth that's coming. So we're now finishing that phase of the story, and that will then evolve into a sort of ongoing continuous improvement efforts across the business, which will continue to sustain good margins. But the next chapter for Weir is really about growth. And it's really about leaning into that opportunity, and what we've been building alongside the capacity changes that we've made is a pipeline of new products and solutions, and the software businesses, so our relevance to the global mining industry is ever growing, and we have a great opportunity in the years ahead.
I mean, working capital increased during the year. Should we expect this to revert closer to historical levels in 2026?
That we should. We had a specific spike at the end of 2025 reflecting actually some of those manufacturing changes where we were holding extra inventory to make sure that we supported customers while we were closing plants and moving production around. You've also got the effects of tariffs, so we passed all the tariffs on to customers in terms of price increases, so protecting our margins, but they're added on to all the inventory you've got at the end of the year where you've paid those tariffs, so that was also a little bit of a headwind for us. But as the platform normalizes, the working capital should come back down to our target of around 20%.
Yeah, just very quickly, I mean, there's a lot of volatility also when it comes to currencies and markets. Does that impact your thinking? Do you hedge? Do you need to hedge, for example, when it comes to currencies?
We don't really have much transactional exposure. Obviously, we're a sterling company, so we have translational exposure, and we operate in many countries around the world, so we have that, but we don't have much of a need to hedge anything from a transactional point of view. Look, I mean, it's the world's been quite volatile for a few years now, so we're getting used to working our way through it and being resilient as usual.
John, thank you so much. John Stanton, there, Chief Executive of Weir Group, joining us this morning. Now, there is a significant headline coming out of the Gulf, Saudi Arabia, saying there was an attempt to attack the Stanton refinery. We understand there was no damage. Again, this is Saudi's largest oil refinery, so any attempt, or actually any attack that would have been successful, would have had a huge impact on the price of oil, something we're watching very, very closely as we are the Strait of Hormuz. Up next, Bloomberg Brief, and this is Bloomberg.